Hello and welcome to Talking Automotive with Mark and John. My name is John Sinclair and my co-host Mark Palavestra.
Hi John. Today we're going to talk about the state of play in 2022 and where do we go from here and what the market is telling us. We've had a number of changes and we're probably getting closer to what could be deemed to be the new normal, albeit with some supply constraints still, a war in Europe, and now interest rates moving.
Yeah, it's very interesting. There's some major changing happening in the market, and these could have a very big impact on automotive businesses. So it's really well worth spending time to consider what is happening in the market. So let's jump into it.
If you like what you hear today, please remember to subscribe to our channel on YouTube, ring the bell so you get notifications when there's new podcasts launched. Follow us on iTunes and Spotify, and our website, autocurrents.com. With 30 years' experience in auto logistics and state-of-the-art locations in 5 major Australian cities, Precar Fleet Services is an independent division of Precar Services, offering specialty fleet fit-outs for commercial applications ranging from simple tray and tow bar fitments to fully bespoke service body and accessory installation. With quality-assured safety, compliance and standardisation of vehicle builds, Precar Fleet Services are a premier all-in-one solutions provider for commercial vehicle fleet operators, leasing companies and original equipment manufacturers. For further information on how Precar Fleet Services can assist in solving your commercial vehicle fit-out needs, please visit precar.com.au and click on the link to Fleet Services.
In the business of buying and selling cars? Then make it your business to join Flippercar, the faster, more efficient car trading platform. Connect to more sellers, find the right inventory faster, and buy trades in seconds. List vehicles in minutes. Instantly connect with potential buyers. Free to sell with no lock-in contracts. Deal with those you've grown to trust or grow your network nationwide and trade in Australia's newest dealer network. Transform your wholesale trading today. Flippercar, speed and connectivity delivered.
Mark, maybe to start things off, can you just give us a quick update of where the automotive market is sitting at the moment and what's actually happening right now in the market?
It's interesting, John. The auto business is one that we love so much. We're very passionate. We've been in this business a long time. And there's always something happening in this industry. I always used to say it beats selling washing machines because there's not a hell of a lot of change in the washing machine business. However, we're seeing a very interesting time. We're now 2 years on from the start of the pandemic. And we know the pandemic caused or induced a whole heap of things. And if we really need to pull apart what actually happened and then have a look at where we're at and where it's going. So when you think of what actually happened in the pandemic, pre-pandemic, we had way too many cars and we had a challenge in getting access to credit. So the rules to get money were very strict. And one of the hardest things was to actually get someone to get finance settled. So what we needed were bigger deposits. And also we had a lot of pressure on used car values. So used cars were depreciating because there was an oversupply and there was a push strategy to get stock reported sold. And it's interesting when you look at the reported numbers, and this is something that we often get caught up on, is that we read the data saying VFAX is on sales. VFAX is not about sales. VFAX is about registrations, and we need to be clear on that. A sale is when someone walks in and says, I will buy this. That is a sale. A delivery is when I take the vehicle. If I walk into a supermarket and buy a Mars bar, the sale occurs because I've picked it up and I've paid for it and I've taken it away. But with a car, it's different. Now, in a perfect world, the car I want will be there. I can walk in, drive it, make a purchase decision, and the gap between me making that purchase decision and actually taking delivery when the sale is recorded on delivery are very close together. But what we've seen over the last 18 months to 2 years after the initial stock got cleaned out, we've seen the delivery reporting, not sales reporting. So sales have actually been higher than what the deliveries have indicated them to be. So therefore, we're now getting to a stage where once the supply comes back, we'll get a better picture. But let's be clear that the numbers we're looking at are deliveries and not actual sales. Sales is when the process of selling and buying actually take place. So we need to look at what caused those buying motives and also look at what the information and the registrations are telling us. So when we look at the registrations, Q1 this year is pretty much in line with last year. So we've still got a constrained supply market, not a lot of cars, and the European brands are suffering more so. We see fits and starts with the Korean brands, but in the main, we have plenty of Japanese supply, which is why the top end is dominated by Japanese, Korean, and then the Thai market, where we get our LCVs from. So when we look at Toyota, still very strong with 21%, you've got Mazda, and then you've got Mitsubishi coming in third for the month. And this is on the back of LCVs and some SUVs. So what we're seeing now is what we're about to see is we're getting a change back to a movement in access to credit. The difference is we've got a situation where during the pandemic, funds were being stored, so net savings increased. So there still will be deposits available and access to finance in the short term. But that will change as interest rates start moving up. That will also change. The other thing that's happened, and we did a podcast on this last year when we spoke with Gina from realestate.com, and the correlation between car sales and real estate. When real estate is buoyant, car sales are strong, because you've got the wealth effect of an appreciating asset being your property and the ability then to access more funds and buy a new vehicle. When we start to feel less wealthy, when all of a sudden there's more money now going into repayments and the asset values are dropping, whether they be on your margin loan because shares have dropped, whether they be on your property because your property has contracted versus what you paid for it, there tends to be a hesitancy to quickly jump in and buy a car. Now, we won't see that come washed out through the numbers because most brands have got a very healthy order bank. Some brands are well and truly sold out for this year. But what we know is that factories need to keep producing, and as supply starts to come back, the tipping point will be when that supply exceeds what the order rate is. And then we'll start to see whether we actually go back to the pre-pandemic stages where there's an oversupply and we start to see pricing pressure on new and used cars. So in the main, right now, the numbers look very buoyant. Everyone's saying they could have sold more cars if they had stock. That is true. There are carryover orders, which is great. And that's very good for the OEMs. It's great for the dealers. Not so good for consumers because they're paying higher prices, but it's great for the consumers because the used cars are still worth a lot of money. So there's winners all the way through, but ultimately someone must pay for this, and the people who will pay will be the consumer.
So, Mark, do you think we're starting to get to the top of that tipping point for the change, or do you think it's something that's going to come through? We're still going to be a short supply for a long term.
John, I personally, just with some of the discussions we've had with industry players, it is definitely a situation where there are carryover orders well into this year. And some brands have orders into next year with certain models. So that is on the back of savings from last year and this year, the stimulus packages that have washed through, the savings from not going overseas, so no overseas holidays, they're now starting. Whereas last year there were no overseas holidays. So the $30,000 and $40,000 overseas holidays will potentially push a new car purchase that wasn't planned for maybe later this year or early next year. That may get kicked down the road because the holidays are in catch-up mode. So the pendulum never stops in the middle. It swings one way and then it swings the other way. On the way through, it will temporarily be in the middle, and it depends on how much time it spends there, but it will still swing. And right now, we won't see the data indicate this, I dare say, until around September, where we start to see a change in the new car order rate. Now, sadly, the general public and the industry doesn't report the order rate. Some brands will report it to each other, but in the main, that's kept an in-house secret, if you like. And it's the reported sales in VFACTS that are reported up into the head offices, and it's seen as the best possible way to measure sales per se. But they're actually deliveries, not sales. The key will be what's going to change the buyer behaviour and what's going to change the supplier behaviour. And we see a number of things changing here in the lead up, or from the pandemic and the lead up to this year and next. And the other thing is the introduction of more and more EVs. The agency model is one thing that has changed that. And I'm keen to get your view on where you see the agency model at right now.
Well, I think we're definitely going to see more OEMs start to investigate the agency model. Whether they will implement it or not, I don't know. But I think you're going to see new brands coming in, that new EV brands, and there's a good chance that they will implement an agency type model. They will not have a traditional distribution franchise network. And as they implement that agency model, it's going to put more and more pressure on margins, because they're not going to rely on that margin for the dealer in the sale of those cars. And the cars are going to be sold online. The other big part of EVs is, I think with EV models, they're going to become more like a commodity. So you know what you get, you're happy to buy it online, you'll buy it, you'll run it for 3 years, you'll sell it. So it's because it's a commodity, it's a lot easier to accept a purchase online. So as you start to see that, that's going to drive down pressure on the different margins. So you're going to see more and more agency models, and that's going to force more and more OEMs to investigate the agency models. So I think it's something that is coming. How fast it will roll out, I'm not sure. But I think it's something dealers are going to have to be aware of and have to consider in their long-term planning of their business.
It's an interesting one. I'm with you on the agency model, but I actually see there being the two schools will continue. You'll have one school of thought which want to go down this competitive advantage, if you like, of taking cost out of the distribution channel by controlling it and selling directly to the consumer and having an agent provide the delivery experience. And therefore there's more control. And we had a very good conversation with Adiba and also with the team, with Peter Voyan from South Africa, looking at the South African experience. And ultimately it came down to more control of the delivery process by the OEM, but then basically the price paid goes up. So ultimately the consumer pays more. Now the question is, does the consumer get a better service through that process? And will there be an opportunity for the traditional business model with franchise dealers, if an OEM gets that relationship right and really engages that network? There is definitely an argument that still exists that a motivated and engaged dealer network provides the best possible delivery experience and customer experience for a purchaser of a vehicle, an operator of a vehicle, where you've got someone with skin in the game who has a vested interest in buying and selling vehicles from the market, and the OEM is supplying that dealer with product and basically wants to be left alone to do their business in line with the OEM's expectation, but also meeting the customer's needs. So there's definitely there's an argument to be said that a franchise business model still has some legs and still has some opportunities to have a competitive advantage in another way versus the agency model.
Yeah, I think, Mark, you make some very good points there. I think the difference is it depends on the type of vehicle. So I think your more exclusive, expensive type cars and that, there's a very good chance that they probably will remain in some sort of franchise type model. But where the car becomes a commodity, your entry-level type cars, small EVs, where there's not much difference between this car and that car, those can easily be sold online. So there's not much difference between brand and that, and people aren't going to worry as much about the service and that. As long as you get your car, it's reliable, it runs effectively, and you don't have major problems with it, I think you'll be happy wherever you buy it. But I think the other point you made, I think the customer will, in the short term, pay more under the agency model because there's less opportunity to negotiate the price because it's a fixed pricing model there. But as competition increases, medium long term, I think those prices and those margins will be driven down. That's sort of my gut feel and what I sort of expect from that.
It'll be interesting to see what transpires. So we see in the short term definitely that the prices have increased and the volumes have decreased. Now that works if you're just using a test market where you drop volume in one country, but you're still running volume in other countries to keep your factory going. Because this is one thing that we all forget, that ultimately a factory has to produce these cars in quantities that are cost effective. So if that is no longer cost effective for the factory to build, say, 600 cars a day, the break even may be 650. That factory needs to be producing more than 650, 700, 800 cars a day to achieve a number that actually provides a positive return. If your volumes drop below those critical levels, you may be making good margins on low volumes, but if it's still below the economic rationalisation of a break even and then having economies of scale with products that you're purchasing and inputs into the vehicles, then you start to run into significant difficulties. You then need to find other markets. Now, if all the other markets are full, you then need to start oversupplying. And this is what it will take. It will take one or two brands to get to a situation where there's capacity and they need to ramp up production that they will then push, and then you'll get to this situation of price distress.
Now, Mark, the other big change happening in the market is the right to repair. And we've seen that legislation is going to come through sort of mid-year in Australia. Now, we are going to be talking about it in more detail, but just as a lead into that podcast in a couple of weeks' time, do you think that right to repair is going to have a big impact on the traditional franchise dealer as authorised repairers start coming in and have the right for technical information and the right to repair those vehicles? What's your feeling on that?
There definitely is a risk, but what we tend to see with the franchise dealer network is the vehicle is retained in the franchise dealer network for 3 years, and we know through the data that it progressively drops off after year one. The retention, there is leakage immediately into the aftermarket. And the aftermarket is huge. As we had the discussion with Stuart Charity from the AAA, he outlined how big that aftermarket business is. And it's terrific. That sector does a great job in maintaining the 18 or 17 million cars that are no longer who are out of their 3 years of franchise dealership service. So there's a lot of cars that are serviced outside of the franchise dealer network, more so than in the franchise dealer network. So these businesses need information as the vehicles get older and get that right to repair. Many OEMs wanted to use the technology to try to retain those vehicles within the franchise dealer network. They were losing them anyway. And this is a problem. If the aftermarket doesn't have the correct information, the brand ultimately will suffer. So whether it's serviced by a franchise dealer or a non-franchise dealer, it's still that car. The owner of that car will say, my Acme motor car is no good because it's 4 years old, or I bought a second-hand one. It's a new car to me. I'm getting it serviced at my local garage and it's hard to fix. Therefore, there's a problem with the car. So I see an upside for the brand. It's not particularly great to potentially lose service work in the first 3 years of a vehicle's life, but ultimately that vehicle will be gone. And the key there is not so much be worried about the information and the technology. The key is to look after the customer right in the first place to retain them. And there are many franchise dealers, and I've actually worked with in a number of them, where those dealers retained service vehicles way out of the vehicle's warranty. And those customers were still engaged because those dealers were very good at looking after the customer and engaging with them and promoting older vehicles to come in for service, not just relying on new cars coming through, servicing them for the first 3 years and just knowing there's always going to be another new car being sold so we can get more volume. So I personally see there's a risk for sure, but I actually think the winner will be the customer. And if they get it right, the OEMs will be winners as well, because it means their vehicles will be fixed by more people.
Yeah, I think, Mark, you make a good point. I think the customers will always be winners in that regard because it increases competition and drives through that the pressure on the margins. But I think it's also interesting. It'll be interesting to see how it's actually set up, because if they set up as authorized repairers, it will sort of increase the link to the OEM. So that OEM will increase parts sales because he'll now have a proper link to these authorized repairers who then can buy parts directly from the OEM. So their part sales will go up substantially, and they will, in a way, grow their sort of market in terms of their control over the market, where it might not necessarily be through the franchise dealer, but it'll be through the authorized repairer. So I think it's an advantage to the OEM, but it might put pressure on the franchise dealers in the medium long term.
Oh, absolutely. It's a bit like our conversation with Michael Winkler, where the dealers who embrace the valuation tool and show the transparency and give the customer a good experience. Because if you give the good customer a good experience, there's that transparency and trust, saying, hey, this is what your car is worth, and I'm not going to dodge you because this is what people are offering me to buy your car off you. So it's that transparent process. The same goes for if you look after them properly in the service department, you'll then have the best opportunity. You're not going to win everybody, you're not going to keep everybody. And we don't have that fantasy that we think that we're going to keep everyone and keep everybody 100% happy. The key is to get it right in the majority of instances. And that's the beauty of this business. It presents plenty of opportunities when things go wrong to address the situation.
Yeah, I think that's where the opportunity lies in that first stage for the franchise dealer, because you already have the customer. So if you can show you can be very competitive in that 6th, 7th, 8th, 9th year, you should have a good opportunity to try and retain some of those customers. So it's the ability of the franchise dealer to try and show the customer that he is competitive and he can offer the right sort of service into those later years. Now, Mark, so we're starting to see a range of changes in economic conditions. You sort of mentioned them earlier in our discussion. We're seeing inflation increasing substantially. We're seeing cost of living price pressures. We saw the increase of interest rates today. Do you think that's going to have a major impact short term on car sales, or do you think that just because of the short supplies, it won't really have much impact?
Well, it's interesting. Let's talk about what's going to drive the future. And the future can be short and long term. You know, everyone thinks, let's talk about flying cars as the future. Yeah, eventually we'll probably get there. Electric cars are the future? Absolutely, we're on our way there. The future is also here and now, next month, 2 months, 6 months, 10 months, next year. So right now we're seeing, and the important bit is we are so guilty, and unfortunately the industry, the reporting that we do, doesn't help when we just compare it versus the same time last year. Same month last year, same month this year, what car's a bestseller? It is such a narrow view. If we think of driving down the road, if we're only looking at just the end of the bonnet versus where we are now, that's a very, very narrow view. And it doesn't give you the full perspective as to what's going on. If you looked at share prices today versus yesterday, is that a gauge to work out whether you would buy that stock or not? Absolutely not. You look at technical analysis, historical, what's a trend telling us, and then you overlay some fundamentals with it as well. So let's look at the fundamentals. People need money to buy cars. People need cars to be available. People need the type of car that they want to buy, and people need the type of fuel to drive that car because it's a cost, and also there's an environmental consideration around it. So right now we're going through some big changes. We've gone out of small cars, we've moved into SUVs, and we're into the pickups. We love our pickups because they're both of those SUVs and pickups are versatile vehicles for our lifestyle. We've had a flirtation in this country with diesel passenger cars. They're now gone because Europe no longer makes them. But diesel is still increasing in sales every month. And that's because of the SUVs and the pickups. Now, we know there's going to be EV variants coming, but right now, here and now, the trend is that there's still an increase in diesel consumption. And it's funny when you look at the excise that was cut to try to ease a bit of financial pain on the back of this war in Ukraine. we see that petrol's dropped, but diesel's still fairly high, and it still remains around that $2 a litre. When fuel is at $2 a litre, that was always a tipping point that we would discuss as the time that EVs really make a lot of sense and are very attractive. And what you'll see is as fuel maintains around that $2 a litre, that EVs will gather more and more momentum quickly because there's an economic realisation. Unfortunately, economics beats environmental in most instances, but there are obviously those that want to buy an EV for the environmental consideration. So here we have this situation, petrol's on the decline, EVs are on the increase, but diesel's still going up as well. And that's coming up because it costs a lot of, people can feel the pain as they fill up every time. Charge a car, you don't feel the pain. When you feel the pain from an interest rate increase, it's like, am I going to rush out? I mentioned before, my house has just dropped in value, and luckily I've got some savings. I've got a deposit. I can write an order to buy a car and take delivery of that car in 6 months, 7 months, 8 months, something like that. So right now, am I still going to rush out and do that, or is this going to put the brakes on me until I just weigh up? Well, hang on, where does this go? And especially when the Reserve Bank's talking about increasing rates again and ratcheting up. The US is going to be increasing rates. The Australian dollar has to be maintained, so the Australian Reserve will move rates up as well. Because that's the other whammy. If the Australian dollar drops, suddenly the cars get very expensive from an OEM perspective. We consumers don't see it up front, but ultimately someone must pay. So the OEM is a shock absorber to a certain point. They'll push the price to us. Right now, they're pushing the price 100% to us, and their margins are quite good at OEM land. But when that dollar drops into the 60s from the US perspective, or heaven forbid even to the 50s, then there's a world of pain. There's no one's making money, and then the prices will be up. But at that same time, if interest rates are rising, then consumer sentiment starts dropping, and then you start to see pricing pressure start pushing prices down. When pricing pressure pushes prices down, dealer profitability starts to suffer, inventory starts to build up, then floor plan costs start to return, because right now there's very little floor plan cost, but then floor plan starts to return, and then profitability starts to get eroded. Right at the same time as you're selling more EVs and doing less service work. So these are the things that we need to think of in where the future's going. Now, this future is not going to happen straight. That pain won't be here in September this year. That pain potentially will be here September next year, or even the year after. So we need to be very mindful that these are the short to medium term impacts of what is now starting to happen in this post-COVID environment. Right now, when I talk about September next year and the year after, supply will have returned to normal. But the supply will have returned to normal in a way that's going to have more EVs, because we're going to get more brands. And David Wynn outlined this in his podcast about the supply of Chinese EVs are going to come into this country because they're quick to get here, they're cheaper to build, and they will start to make inroads into the Australian market because there's SUVs coming in, and that's the best-selling car is an SUV, and followed by a medium pickup and cab chassis. So what we're going to get is these vehicles, short time frame, lower price, but once again, lower service work, right at a time when the opposition are going to be going at the high-end price. That market is going to get a bit tricky to be selling $100,000+ EVs when interest rates are high, real estate's dropping, overseas holidays have consumed a lot of that disposable income, and we're going to start to see probably a normalisation of what goes on from a supply and order right perspective.
So Mark, considering everything we've spoken about this evening, what do you think are the things that the industry should focus on for the next 6 months in terms of with all the changes happening? Where should they focus their efforts and preparation for what's going to come in a year to 18 months' time?
The key right now is to get back to basics. I know we say it in pretty much every podcast. It's getting back to those follow-ups, engaging with customers, because the customers are going to go through a bit of a bumpy journey. Right now, they're smooth sailing, there's plenty of carryover orders, and it's going to be great well into the back end of this year. But what we're going to start to see, the order rate starting to drop. it will start to get harder to sell a car. That's a trap that we will fall into, whether we're an OEM or whether we're a dealer, whether we're a used car trader. We really need to be looking for signs for when the market starts softening. The data won't show it up front. And that's where you really need any business, whichever business you're in, whether in OEM land or dealer land or in used car land, it is looking for the signals from your buyers, whether it's the OEM from a dealer perspective, a customer to a dealer, whether it's a used car trader, looking at what is the actual market sentiment of I will commit to this product or I will bring in this vehicle for service. What is the consumer behavior actually doing? Tracking that inquiry and seeing if it drops. Tracking the commitment levels. And the commitments are, I'm going to place an order. Don't be fooled into just saying we've got enough stock coming and we've got enough carryover orders. The orders do dry up and they will start drying up, but they'll be hidden by deliveries. And this is the key, to look for what are those triggers, and then it's a bit getting back as soon as it's happening to make sure you're getting the basics right. Really engaging, staying close, keeping the communication going, all the things that we talk about in good engagement processes with your customer.
Now, Mark, we saw a lot of businesses let go staff at the beginning of the pandemic. What's your view on that? Should businesses start looking to start re-employing and retraining and getting staff back in now? Or do you think it's too early for that?
It's a very tricky one, because there has been the great resignation and there's been this transition of people. And it's funny when the more people you speak to in various industries, I've just started a new job. The grass always looked greener. And I know it sounds cliche. And guess what? Our forefathers were actually smart when they made up these proverbs, because they were actually right. So all of these things, and just because there's a new technology, just because we've got Zoom, just because we've got this internet, doesn't mean that the old proverbs don't exist anymore and aren't relevant. They're more relevant today than ever. And what you've got is a situation where, okay, I hated my job, they screwed me over so badly, I've now left and gone somewhere else. But guess what? Where you've gone to, someone else said exactly that same thing and they moved somewhere else. So when these people land, it's that whole question of, well, hang on, is this the same proverbial and just a different location? So that's a trap for those that leave. There is also a trap for those that didn't look after their people. When you've got good people, you want to keep them. You want to wrap them in cotton wool. So there are those businesses that said, right, I'm just going to stash staff and let them go. And those people will remember that and say, well, I'm not going to go back there. Or they'll say, they'll advise people who are looking for a role to move to, say, don't go to that place. That means that that organisation is now behind the eight ball and has to recruit blindly and has to recruit with best endeavours, and hope is not a strategy. So there is a risk for, if you let go people to take advantage of greater profits, that as a result of that, you're not going to necessarily attract and retain good people. Right now, labour shortages are across every sector, whether it be front end, back end, whether it be from a service and maintenance perspective, whether it's a delivery driver. All these people are good people are in short supply. So that may change. Immigration may loosen that up a bit, but the fundamentals of being an employer of choice, attracting and retaining quality people, training them and keeping them engaged in the business and in your customers is going to be the key.
Yeah, I think it's going to be a very interesting time over the next year to 18 months. So fascinating. So great to talk to you again, Mark, as always.
If you like what you heard today, please remember to follow us on LinkedIn, Spotify, iTunes and YouTube. Follow our website on autocurrents.com.
Thanks very much for listening.